don't do that. I have a very sporadic hairstyle right now. Therefore, my webcam is not on. Today, we're gonna talk about the very interesting elephant in the room, which is the uncertainty of the market. And we're gonna bring in some data analysis as I'm finishing up my final project for a master's. I did something stock related. I analyzed Nasdaq, analyzed a lot of other stocks, and yeah, I think it's really pertinent that we talk about big data, so then we know what to do. So basically, the prelude of this is we have a COVID coming, and I mean, COVID is already here for a long while, and then now we have another variant. So then our job as a trader, data analyst, hedge fund manager, or whatever you are, right? Who cares about the market? Essentially, what we need to objectively and semi-subjectively verify how much the shock of COVID is actually going to worth. So how we're going to do that is we're going to go back and look at this huge dip. This is around the monthly huge dip during 2020 where people are, let's just say people are very uncertain about where COVID is going. And it created, so basically if you go look at big shocks like this, there are always going to be a reason, and it usually lasts about a month, and the highest is 2 months. So if you just do a very interesting data analysis, let me show you guys. So what we did, or what I did, is we analyzed the daily distribution return of Nasdaq, and we analyzed the weekly and monthly and yearly, quarterly, and so on and so forth. So what we really found is when there is a big shock on the daily, and if you look at the distribution on the daily, you will realize that something very interesting is going on. So on the daily, the statistics of the probability goes as following. If on the daily, Nasdaq go up by 5% or go down by 5%, it's basically abnormality. That means it only happens 1% of the time, even less than 1% of the time. Actually, it only happens 0.5% of the time. And when that happens, what you should do is usually what people will recommend you doing, or I mean, I'm not a financial advisor, so I do not give financial advice. Therefore, everything we say on this channel is for shits and giggles. When you have a 5% outlier coming, it's probably better to sell call options or just sell out positions and wait. When you have a 5% decrease in the Nasdaq, you should always buy, because on the second day, you have a 97.5% chance of rebounding. So how are we gonna use that graph, statistic, and standard deviation to help us figure out what is like the right thing to do as of yesterday and as of today? So yesterday, what really happened is, how much is this? It's 15,745. So if you do the math, it's 15,745. The daily return of yesterday was 15,745 minus 15,257. And then divided by 15,745. That means it went down by 3% on the daily. So if you go and look at the chart that, we're probably going to give it to you guys. It's 3%. So in between 0 and 5% is 2.5%. 3% lies outside of here. Let me show you. So this is 2.5%, and then this is 3%. And if you see the shaded line here, this is one standard deviation. So one standard deviation over here captures 68% of the time. And then 3 went down by about 3%. It lies like in between the first standard deviation line and the second standard deviation line, and then it is really close to the second standard deviation line. So that literally captures 95% of the time. That means market went down by 3% on a daily is actually a 5% probability event. So what's gonna happen is most likely there are 87 to 95% of the chance that whenever that low probability situation happens, you have a 87 to 95% chance of buying it on the beginning of the market next day, and you will yield about 0.5% on the day. So let's see that if that's correct. And if you want to see the very detailed analysis of how do I get an 87% to 95%, I can show you guys actually later on. If you guys, there's a lot of you request that, I'll either put that on Patreon. And again, I still don't have access to Patreon because number 2 is a little bit busy these days, and he has a verification code. We sort of split up like the platforms, and I can give you guys a very interesting rundown on this presentation. Actually, I just did this presentation yesterday, and I probably will give it a very brief presentation on YouTube for 8 minutes. Basically, we figured out a very lazy way to invest, and you can probably make if you are lucky, you can make 27% on a yearly. But if you are unlucky, it's almost impossible to lose money. The probability of losing money is 0.1%. Basically, if you use this method, the probability of you, for example, if you invest $1,000 in a market on day 1, and then using this stupid lazy method that you don't even need to look at the stock every single day, you might just want to check it like monthly. And then what's gonna happen is after a certain time period, it's literally impossible to lose money. Like, it's literally impossible to lose. The maximum downside is less than 2.2%. So that means if you put in $100, the maximum damage that you will get is losing $2.2. But the highest amount of return, or the normality return, so you have a 70% chance of yielding a 15% return if you actually follow the strategy. But anyways, we're just gonna use this this Python script for analyzing today. So we went down by 3% yesterday on a Nasdaq composite. That means, if we buy it low today, we can have a almost guaranteed 0.5% increase on the day. Guess what? We have a 0.83% return on the day. Okay. You guys are like, oh my god, that's interesting, right? Yeah, this is why like big data can actually help you with investing, but it can only help you make like certain pivoting extreme situation. Because so basically, if we analyze this a little bit further, that means, so if you are a day trader, if you're not a really good day trader or the average day trader, in here, that literally means the probability of you winning or losing on a particular day trading is actually a coin flip. And it's actually a really fair coin. That means if you're a lucky person, you probably can win more than lose. But if you're an unlucky person, you lose more. So basically, if you're trading Nasdaq, we're just talking about Nasdaq here. If you're trading Nasdaq on a daily, that means you're literally gambling. But your odds is actually higher than going to a casino, way higher than going to a casino. So we see a big dip here, and we see a very interesting follow-up, just like what we induced from the data analysis. So what really is going to happen tomorrow? Well, here's the interesting part of what big data cannot tell you, is when you have an extreme event like this, that means tomorrow, the uncertainty. So what is interesting here is, sorry if I'm rambling a little bit, but I hope this video will help you guys understand how the market is structured. What happens here is you see this big red candle, right? You guys are like, oh my god, a lot of people oversold here, and then this is like the most panic day. No. This day is actually really certain. When you see a Nasdaq go down by this day, you can actually start buying like by the end of the market, and that's literally what a lot of institution people do, right? Institution people do, because a lot of times you cannot really enter in the beginning of the market, because that's where volatility is really high. So what they will do is by the end of the market, they will buy in. And by the beginning of the market, they were buying a little bit more and wait until this point. And if they're like executing on a daily to just profit off of big data analysis, then they would probably sell off like by the middle of 8 a.m., right? And you guys see this, you're like, okay, so what? What this line really means on a technical analysis standpoint or on a quantitative analysis standpoint is you establish a price line consensus of here. So basically what the chart is telling us is the market believes that 15311 should be a fair value of where the market is sitting at. And therefore, the rest of the week, I mean, again, it's really tricky. Tomorrow is Friday, and Friday have option expiration, so we haven't taken account. Let's just say this situation happens on a Wednesday. So if this situation happens on a Wednesday, what we can actually do is, I don't have a virtual machine open because I tend to code on my other PC. What we can do is we can actually go back and put that scenario into the program and run a simulation. But right now, I don't have it open, and because simulation is going to take a lot of RAM, I don't really want that to happen to my computer while I'm streaming. So then if that happens, we can go back and plug it in, right? If that plug it in, you will see that there's a higher probability chance of it actually reach a basket here. And then it's even have a higher probability chance of trading at 0% gain on the top of here. So that means what most likely will happen is tomorrow's closing price will almost equals to today's closing price. That means tomorrow the Nasdaq is going to trade flat. But what makes this problem really complicated is because tomorrow is a Friday. So when you have a Friday, you have option expiration. And usually Friday we generally see bigger volatility on Mondays and on Fridays because of option movement, right? So then that makes it really uncertain. Because when market establishes a line of, okay, so we're going to pivot over here, what the market maker will do is they're going to gamma hedge around it. So if you have call options that are overtly lying on this line, the ending market price will be lying under that. If you have a lot of put options expiring, then it will do the opposite. But what makes this situation even more complicated is depending on the call and put spread, and depending on the call and spread extending to next week, the market maker has to. So let's just say a lot of people start buying puts on Friday. That means market maker has to hedge for the gamma. That means the stock price will actually go up. If a lot of people start buying puts on a Friday, then in terms of because you gotta deal with the gamma. So then you gotta start selling a little bit of your position as you hedge of what the market really wants to see. I mean, again, market maker makes money off of volume. It doesn't make money off of what do you call that? It doesn't make money. Off of general market movement. It's something I will make another video for. So a lot of you here just want to hear like what the Nasdaq is gonna perform. So first of all, a lot of you are gonna be like, hey guys, this is a downward trend. Well, actually, trend lines does not really matter on the Nasdaq. If we go oh my god, I'm actually gonna go make a video of my findings again. So how Nasdaq oscillation works is it doesn't oscillate as a sine graph. So the sine graph goes like this. That means the top wave and the bottom wave is the same, right? Like if you look at the volume of here, this should be the same. But the Nasdaq is really skewed. It goes like this. So the top wave will be a little significantly higher than the bottom wave, and the bottom wave will go up, and then the top wave will go like this, and it will go like this. The general trend line is always going up. Even when it's trading flat, the general trend line, if you look at the monthly general trend line or the yearly monthly general trend line, the slope is always going to be bigger than 0. That means if you see an oscillation pattern like this, well, let's just draw this, right? You see an oscillation pattern like this, you see an oscillation pattern like this, and you see another oscillation pattern over here. That means, okay, so first of all, when you look at this, what do you think your maximum downside is? Your maximum downside is towards the yellow line. So we can actually make a more in-depth video of calculating your maximum downside and figure out what you're gonna do with your holdings. But right now we're just gonna predict what's gonna happen tomorrow. So for tomorrow, what really is the worst case scenario is it's gonna do another gap down. But when it do another gap down on a day when flash out happens before market even happened, which means there's a gap down, that means tomorrow we're gonna see a pull up towards today's opening price. Does that make sense? This is one scenario. And scenario number two is like we said, we have a establishing line and people are playing calls and puts, and usually, so the range of tomorrow's Nasdaq, that's actually very interesting. The range of tomorrow's Nasdaq is literally top capped, let's see. Top capped at about 1% cap, and then bottom cap as a negative point, I think it's 0.6%. And your maximum downside is actually a negative 0.2%. So tomorrow, if you do a probability weighted average calculation or whatever, the probability of you making profit tomorrow is essentially less likely than losing profit, okay? And what is interesting here is when you're doing those analysis, we're assuming that you actually sold off in here. That means you have dry powder. So the most rational thing to do here is to sell off today and then wait until tomorrow's market open. If the market open and gap down, then you buy in and set up a price that you think is reasonable that's oscillating around the 0.5 plus, right? And then you will dump it again. But also depending on your long-term anchoring position, if you want to know what long-term anchoring position is, it's basically a priced estimate for yourself. Like when you're investing, you always have a sort of like a valuation floor and a valuation cap. When you reaches your valuation floor, you want to buy more of the stock. This is why Cassie would keep buying on Robinhood, because Robinhood is lower than the valuation bottom for the insider investors. But anyways, we're here for Nasdaq, so we're gonna continue talking about this, okay? So you're gonna oscillate around the 0.5% top side, and if you are safe, what you're gonna do is you can actually use TQQQ's 2x leverage and then make about at least 1%. If you trade options, you can make about 15% on the day, assuming you have more than $25,000 as the limited day trading limit. And then what you're gonna do is you're gonna liquidate that and then wait for the second day. Because what we are really not worried about is we're not worried about the downward trend. As I talked about before, downward trend does not matter when you're trading on Nasdaq. What you should really worry about is this. You see this COVID scare? What we really need to quantify is, so we have the Omnicorn. Is that how to say that? I'm just gonna say it as the Omnicorn. How bad the Omnicorn variant actually is in terms of towards the economy. It's totally not gonna be as bad as this. So you rule out the 30% downward trend situation. That's impossible unless people just super retarded and overreacting. Sorry, I use that word. I'll put that into inappropriate language or whatever. So 30% is not likely. What about half of 30? So it's gonna have half of an impact. So if we go look at the global supply chain, it's actually keep healing it up a little bit, and the global supply chain actually stabilizes. And then with the inflation stabilizes at a high level, the global supply chain actually will just operate on a normal level. So 15% actually wouldn't be something that we're actually looking at. So we can actually set 15%, the negative 15% downside, as a bottom safety estimation. So this is our maximum downside here. What is the most realistic downside here is about 1/3 of that. Or actually half of that. So you will have so 1/3 of that was a very reasonable estimation considered on Nasdaq. So 5%, we have a 5% healthy correction due to COVID. This is, if you would do a cumulative probability distribution, that means this is actually really likely. So you would probably anticipate a 5% cumulative downside on the Nasdaq. We will probably already achieved at least 3% off of that. And then what most likely what happen is gonna reach cumulative a cumulative downside of 7.5% to an 8% correction. So then what we do is we go back to our top here and then basically look at, and then also what is interesting about valuation is you have to think about what point you want to pick is your baseline. So it's probably not a good idea to put it as the highest point as your baseline. We want to pick a sort of like an oscillating average. So what we want to pick here is probably not here, but here. So 15707, let me write it down. So 15707 is the price that you want to pick. And then you want to do the calculation of -8%. Okay, let's see. Since I'm a YouTuber, I will do the math for you. So your predictive downside here is, whoa, it's actually pretty interesting. Damn, this is a very interesting coincidence. Your predictive downside is actually the next technical analysis trend line here. It's right here. So what does that mean is when market dip down under this point, start buying, right? And then you wait about 3 months, you definitely have a profit, okay? I mean, again, we're not financial advisors. We're not financial advisors. We do not get financial advice. And everything we say on this channel is for shits and giggles. But this is what actually, essentially what my data findings is telling us. And what is most likely is because we both know that, guys, COVID is just, you know what I mean? So what most likely to happen is the shocks are probably gonna stop at 14,900. That means when it reaches 14,900, you can all look ahead for 1 month to buy the 15,000 call option on the Nasdaq, and then when it reaches 15,000, you're probably gonna have another drawback down, and then you will have an upwarding trend. I mean, again, that's what 40 years of data told us, right? I think this is it. Thank you guys for watching, and smash the like button and subscribe. If you like more of these kind of content, let me know by comment down below. See you guys on the upside.